take a look at the case for perhaps a little bit of the weakness in the ESG space. Shaw Hickman, research lead, Market Matters, and his charts are here with me in studio. Hey, Sean, nice to see you.
How are you?
Yeah, good. Taking a breath from all those reports coming through. I'm so tempted to ask you, but I'm going to stick to script because...
Feel free.
All right, BHP.
BHP, it's a cyclical stock. You know it's a cyclical stock. It's so heavily researched. A little bit of a nuance here or there on the numbers. 2% drop, I think it's down at the moment. It's nothing. It's going to go where operationally it can get the staff, what costs are going to be around the staff. And of course, it's going to be dominated by the Chinese economy and the underlying commodities. We're long BHP, we like it, but we're not as long as we were.
Okay, there you go. You're long BHP. Where are you seeing this weakness coming through in ESG? Is it just a pure reflection of the fact that, the dynamics out there have changed? War in Ukraine, the list is quite long as to why many investors are potentially re-examining investments that they had, for various reasons have been out of before.
Absolutely. There are a lot of balls in the air, as we know. There are a lot of things going on. But there are two factors I think that are dominating. The price of lithium is coming down. That's being paid in China. And secondly, it was and still is probably a very, very crowded space. A lot of the fund managers, a lot of people don't want to buy coal anymore. They don't want to buy fossil fuels anymore, but they want to be part of the battery revolution. They want to be part of the new green world. And I think we all do, but at what price? And if people have paid too much and they're too long, who's left to buy inflated prices? And I think that's one of the reasons they're coming back. It's quite simple, supply and demand.
Okay, so are we talking what companies? Mineral Resources?
Mineral Resources is one we're looking at, one we're looking to buy into weakness, IGO, Pilbara, there's quite a few of them.
Okay, and so is this weak enough for you to buy in?
Not yet, no. We think it can get under $75, $70, that sort of region. But it does report, so it's like all these stocks that are coming on reporting, I might look silly, and we might miss an opportunity. But we'd like to buy at those sorts of levels, assuming nothing comes from left field in the result, of course. But we feel like the downside momentum, these stocks have generally fallen 15 to 20%. I don't see them, any reason why they can't come another 10. If you look at how far it's rallied over the last, what we're talking there, less than a year, it's gone from $1.97.
This one's Pilbara, yeah, sorry, we moved on you, but what about it?
I'm too slow for you.
No, you're not at all.
Well,
I think everybody's just really touchy because of reporting season.
But that's another great example. Look at Pilbara. It's gone from $2 to $5.66 in, what are we talking, well under a year. People are long, people are optimistic, everyone wants to be part of the lithium story. It's just having a very, very healthy washout in our opinion. It's a quality stock. We sold that out of that stock around $5.50 for our emerging companies portfolio.
Well done.
Pretty lucky, actually.
Yeah.
Let's not get too much of a pat on the back. It just felt overcooked.
Uh-huh.
And at some point in time, you got to say it might be a great thematic, but if it's overcooked, people are too optimistic, take some off the table. But we will be entering back under $4. We'll probably start accumulating again.
Okay. What about IGO? I still call it Independence Group. IGO, is that cheap enough for you yet?
Again, this is a stock we've trimmed into the strength, about $16, or I think $15.99 to be precise. I wish we'd taken it all off the table. It's come back again, that 15 to 20%. It's got a slightly different dynamic as well because it's very heavily exposed to nickel, as you know. And we are talking, people are now starting to talk about secondary battery technology coming through with less or no nickel usage, etc., etc. I think it's a good stock. We might look at it lower, but probably would look at Mineral Resources rather than that. We'd rather hold a smaller exposure to IGO than we were before.
Do you think it'll come back to that $9 level?
Probably not.
No.
Probably not. It's still a very good quality stock. It did a fantastic purchase when it bought Western Areas at the price it got it for. So again, they're all falling by the same amount, 15, 20%. If it comes back to anywhere around 12, I'd probably find it very hard not to buy some.
All right. Well, talk about the banks v. insurers right now, because that CBA result, it's not recovered yet. I don't know if it's had a day that it's finished in positive territory since that result came through, but the insurers have reported quite well.
That's right, and CBA was up yesterday. But
was it? Oh God! See?
Sorry, I'm being being a bit cheeky. No. But I think this is a bit of an interesting time. UBS came out with a report yesterday, and they said that they now prefer the insurers over the banks, and there's a lot of logic in what they're saying. The banks have run very, very hard. Everyone's looking at increased margins because interest rates are going up. That's happened, but CBA made all-time highs only a few weeks ago. Now it's corrected about 10%. There's not a lot of built-in risk factor for bad debts escalating. Everyone knows interest rates are going up. Everyone knows a lot of people are going to be struggling for cash and struggling to pay their mortgages. Nobody quite knows how bad it's going to be. Central banks, Mr. Lowe has said, or Dr. Lowe I should say, he said he's going to be ruthless towards inflation. So that means they're really going to get quite hard. One would have to assume they're going to follow through in all this rhetoric. So it's hard to see the upside for the banks here in the short term, whereas we saw QBE recently come out with a great result. So I think on this particular case, I think UBS are probably on point. If I was to say out of the banks, we're long ANZ, we're long Macquarie, we're long NAB. They're our favourite three, but we are underweight as a combined sector. Mm-hmm. And rather than we'll add to those three, if the market comes back further, another 5%, we'd probably start tickling some more on. But if I was to say which one of the financials right here, right now would be our favourite, it's probably QBE, even though it's gone quite hard. That result was great.
Yeah, and so definitely prefer QBE in the insurers over IAG or Suncorp?
Definitely over IAG. If you want to go to sleep, by IAG. It hasn't moved anywhere for years. Suncorp's just reshaping itself, obviously, after the banking's going off to ANZ, assuming that all goes through. So I just think it's time to leave that one alone for a while. Prefer it to IAG, I stress. So yes, QBE is the one performing. We're seeing a market, it's a very interesting cycle in the market. People are no longer buying, well, they were a few years ago, when people were very bullish. Every time a stock missed and was down by 10%, like a few are today and yesterday, people would come in and buy them. They go bargain hunting. We're not seeing bargain hunting now. We're seeing people very, very careful how they deploy their money. They're buying stocks that perform. They'd rather pay a bit more for a stock performing than buy a so-called cheap stock that's not performing. Mm-hmm. And that's why we think stocks like QBE will keep on doing well, because they are performing, they are doing the right things, and people are happy to buy that quality.